The tax law that just passed on July 4th, 2025, nicknamed the One Big Beautiful Bill, is already rewriting the rules of real estate investing. So if you own rental properties or have passive assets, you are staring at permanent estate tax exemption of up to $15 million per person, permanent pass-through tax cuts, and bonus depreciation that unlocks aggressive write-offs immediately. But you also need to know what to expect next and what's changed, and most importantly, how to win big with the new law. So Jeff is here from Acuity. They are the go-to, source for investors for accounting and bookkeeping, and he is going to break it all down, because if you don't adjust fast, you will leave massive wealth on the table. Welcome to the Closers Club. Let's get into it. Jeff, thank you for joining us today, man. I really appreciate that.
Thanks for having me, David. I appreciate it.
You bet. So real estate investors are staring at literally just sweeping tax law changes with the big, beautiful bill. What's the biggest change that you're seeing for investors? And, what impacts them the most starting right now?
Yeah, so I mean, it's really the biggest thing for real estate investors is the fact that 100% bonus depreciation is
Yeah.
back. Given kind of a quick background on bonus depreciation itself, it allows you to accelerate a lot of expenses that typically you wouldn't be able to accelerate. And for people in this community and people in these circles that are in real estate, where that is so extremely beneficial is because you already qualify for what's called the real estate professional status. And having real estate professional status allows you to offset what's typically passive losses. So typically losses generated by real estate, meaning depreciation, is typically not offsetting your active income. So for example, if you're an agent that also has a portfolio, you're earning active income from being an agent, and you're earning passive losses from depreciation on your portfolio.
Right.
Typically, those losses don't offset your active income. If you're a real estate professional, they do. And now you get more depreciation, which means more losses to offset your income. So you can literally reduce your tax liability because we have more depreciation through this new bill.
Nice. So before we go too far on the other stuff, can we, just for people that are maybe newer, really kind of zero in a little bit on what the bonus depreciation is and kind of what exactly that means? And for me, I've never done it, but I've got 80 something rentals. I've had them for a long time. So is it something how would it work? And is it something I should do?
Yeah, for sure. I mean, really every single piece of real estate that you purchase can have bonus depreciation. This is where most people miss. And so typically what happens is if you buy a piece of real estate, that real estate is going to get depreciated over 27 and a half years.
Right.
So if you buy a $100,000 asset, you're going to take that expense over 27 and a half years, which is the typical life of residential real estate.
Okay.
What the IRS allows you to do, what the tax code allows you to do is say, let me segregate certain pieces of this acquisition into different useful life buckets. So sure, the building itself has a useful life of 27 and a half years, but the windows might have a useful life of 5, and the floors might have a useful life of 5. So just by segregating those costs, you probably heard the term cost segregation studies. That's effectively segregating the cost of your acquisition of your real estate into the different useful life buckets. Now, where bonus depreciation comes in is the IRS says certain expenses in lower useful life buckets, meaning 5 years or 7 years, you can actually take 100% of that. So if we take that same $100,000 acquisition, let's just say 30% of that was related to stuff with lower useful life buckets. So let's say 30 grand is floors, windows, things that you can carve out and say, I'm going to allocate $30,000 of this $100,000 to stuff with a lower useful life.
Okay.
Well, right off the bat, you're not depreciating that stuff over 27 and a half years. So that's accelerating depreciation all by itself. But then the bonus with the One Big Beautiful Bill is, okay, anything in those buckets that you would take that expense over 5 years now instead of 27, we're actually going to let you take all of it in year 1. So in that same example, if we had $30,000 that we allocated to that stuff, you're taking $30,000 in year 1 instead of what most people are doing is taking that expense over 27 and a half years. Yeah. And so it really allows you to now take more expense, which is going to generate more losses from your real estate, which again, as a real estate professional, allows you to offset against your active income.
So can you do that with a property that you've owned for 10 years?
Yeah,
Because
so there are some limitation rules in like when you cost segregate, but what
uh,
you can certainly do is with properties that you've owned for a while, anytime you're doing any sort of renovation, all of those costs are typically you have a big move out, and you're going to be doing big turnover, and it's going to be a $30,000 or $40,000 turnover. You're typically going to have to capitalize those expenses, meaning you can't just take that $40,000. But what you can do is take that $40,000, make sure it gets in the right buckets, because
yeah,
those right buckets allow you to take that expense in year one through depreciation. What's
nice.
really nice there too is like where people get jammed up a little bit is they want to take that whole $40,000 as an expense in year one, and they'll call
Mhm.
it repairs and maintenance. Well, that's actually really going to mess up your net operating income, which might mess up your DSCR covenants. A lot of people have loans, DSCR loans. Depreciation actually falls below net operating income, and all of
Right.
your banks are using your net operating income metric, but repairs and maintenance is in that metric. And so you
Oh,
could get jammed up by like trying to take the expense the wrong way, and this allows you to take the expense without messing up your debt covenants as well. So it's really impactful.
wow. That's I didn't realize that. So let me ask you this, Jeff. In these cases where I buy a property and I do a bunch of rehab and I take all of the depreciation in year one, like what do I do for the other years? Like now I've already used all of that up.
So you're typically in an acquisition like that, you're typically, the ballpark number we use is you're normally going to get about 25%, 20 to 30% of the acquisition cost is year one depreciation. So you're never going to accelerate all of the depreciation. You're not going to buy $100,000 asset and take $100,000 expense in year one. You might take 30,000. And so you still have that additional 70,000 that you are going to depreciate over a period of time. It
Okay.
may be stuff falling into like a 15-year bucket or the building that falls into that 27.5-year bucket. And then
Got
you
it.
always are going to have an allocation of that cost that goes to land, which does not get depreciated.
Got it. So that was my concern, and probably why I've never done it is I was afraid that, yeah, it's great that I get this huge windfall in year one, but then I'm screwed for the next 50 years. You know what I mean?
Right.
And then I'm like, well, then I got to buy something else next year, and I just get in, which is great to buy all the assets, but then I just get into this like crack habit where I have to buy to depreciate again, and it
If, if
would feel like a never ending cycle.
and if you're using depreciation as a primary tool to reduce your tax liability, like if you're, especially if you have an active business that's producing high cash flows,
Mhm.
like you are almost in a cycle where if that's your primary tax strategy to
Right.
reduce your tax liability, you do need to keep buying. But a lot of our clients, a lot of people that we work with, have a strategy of building wealth through real estate, building wealth and reducing taxes. And so the constant acquisition of properties is something that's already in their business plan. But to your point, that does need to happen. And right now it's difficult because deals are harder to pencil right now.
Right. So what are some of the other ways where you guys can help an investor, not only implement this, the cost seg and the bonus depreciation, if I'm saying that correctly, but some of the other strategies that you can help them to, reduce their tax liability.
Yeah, I mean, there's a lot of tax strategies out there. There's a lot of low-hanging fruit tax strategies out there that we see a lot of our new clients just historically missing. Things
Hmm.
like the Augusta rule, things like
Hmm.
having a solo 401k, certain retirement plans. There's a lot of low-hanging fruit. But where we can really help is come in and number one, identify kind of certain strategies that you're missing, number one, but then number two, really weaponize your financials to allow you to make better decisions on operating and running your portfolio
Hmm.
based off of the numbers. So being able to understand at the property level what your NOIs are, what your DSCRs are, and really start to make decisions based off of those. Financial decisions and tax decisions, they kind of all play into each other.
Right. So are there, and I didn't intend to go into this, but like in the services that you provide, is that like an add-on service or is that something that you do for everybody?
So we pretty much do it for everybody. All of our clients that come in go through what's called an Acuity Insights, and that's where we go through, get under the hood, and
Yeah.
understand exactly what's going on and
Oof.
what you need to do to get to best in class back office. And so we do a deep dive on tax compliance, tax strategy. We do a deep dive on finance. What does your CFO function look like? Are you
Mhm.
using KPIs to run your business? Are you projecting? Do you have forecasts? And then what does your accounting function look like? Do you
Mhm.
actually have the infrastructure to produce financial statements that can give you good forecasting, give you good KPIs, and direct a good tax strategy. And so we do that with pretty much every single one of our new clients that come in. Is we do that insights, and then we set the plan, and then we go help execute and monitor the plan.
Well, that sounds horrible to a wholesaler and an investor like me. That sounds like the worst kind of, why would I sign up for that and pay for that? Because it's similar our business. We're a transaction coordination company. We help investors, do paperwork and get their deals closed. You guys are very, very similar on the accounting and tax side. But I think I can confidently say that most real estate investors are absolute shitty at all of these things.
We see, we've cleaned up some pretty messy books, and it's really, it is hard to make it fun, but where it can be really impactful is, wow, I can actually go out and confidently spend another $20,000 on marketing because I know that's going to return me $80,000 4 months from now, and say that with confidence using the numbers. That's when it gets fun, but you need to do the not so fun work to be able to answer those questions and make those decisions confidently.
Sounds horrible. Horrible. But I've been talking to Casey, and we're probably going to move all of our stuff over because I'm the absolute worst at it. I was on extensions for the last 2 years for taxes, so I know that I need to get all of that done. So what else was in the big beautiful bill? I know I kind of sidetracked you a little bit there.
Yeah, I mean that's really the most impactful thing. There's some other things, the Section 179 deduction.
Is that back?
They increased the limit to 2.5 million on there. The QBI deduction, which is a pretty big kind of tax strategy that we also see a lot of people missing. It's called the qualified business income. That got locked in at 20%. So that's good because it's locked. They did some adjustments with opportunity zones through 2023. They extended a couple other certain deductions, and they reduced the cap on certain 1031 exchange transactions. But really, the two big things, and really the main thing for real estate investors, is 100% bonus depreciation being locked in. And it's for any property that you purchased after January 15th of this year. So pretty much any acquisitions in 2025 are going to qualify.
Yeah. And the Section 179, I know that was, maybe you can explain it better than me, but my understanding was if you purchase a vehicle for your business that's over 6,000 pounds, you could write it off 100%. Was that right?
Yep.
But then it started dropping to like 70, 80, 60, I don't know, whatever it was. You couldn't do 100%.
Yeah, so I think they got that. I'll have to confirm with Seth. I'm pretty sure they got that fully locked back in, where it is phasing out, but they increased the limitation of what you're able to, what equipment or assets you're able to use, up to 2.5 million. But to your point, we typically see our clients leveraging that with vehicles, and they're mostly using bonus depreciation on all of the real estate purchases.
Nice. Twice. Once I bought a Tesla X, and then a big SUV, and it was great. So it's been good.
Yeah. If you're gonna buy a vehicle anyways in the business, you may as well get some tax benefit from it.
Yeah, well, yes, that was the great news. The bad news was I spent far more than I ever should have on a single vehicle.
And that's what happens a lot too. And we try and talk a lot to our investors about that. Like, you don't make decisions solely on the tax impact, but that certainly should weigh into the decision.
Yeah.
But it also needs to sometimes be a good investment or worthwhile investment in itself as well.
Yeah. So what does it look like when somebody, comes to you guys and says, "Hey, I really think I need some help. I've kind of muddled through this. I've used some local guy on the corner to do my taxes. I'm paying, out the butt, and it's just costing me a fortune." Like, what does that process look like for someone to come to you guys? And I don't want to say get saved, but get their act together.
Yeah, it pretty much all comes through an insight. And again, that's where we do a deep dive under the hood, figure out what needs to be fixed, and give you the game plan and the roadmap to fix it. At that point, we do that on the tax side, on the accounting side, and on the CFO side. At that point, we say, okay, now you have the roadmap. This is what you need to do. We can help you implement this. And that's kind of the next phase of our customer journey, where then we'll go build all of that stuff. And once we get through building that, we maintain and optimize it forever and keep it so that it's always up to speed, and you're always able to actually have a value add back office function that
Mhm.
allows you to make more strategic and better
Yeah.
decisions within your business.
So do you have like a fractional CFO service, or is it just guidance, or?
Yeah, so we have so it really all starts with the back office. Really, the finance and accounting is the foundational infrastructure of it all. And so we
Mhm.
start there with where are you? You know, some of our clients come in with a very sophisticated back office. They may have a controller in place, they may have a team in place, and we're coming in to support that team.
Yeah.
Sometimes we are their entire back office. We're doing everything from bookkeeping through month
Yeah.
end close, through financial controllership,
Mhm.
through financial reporting, tax, all of it. And so it depends on where you are in your own
Mhm.
journey and kind of what your business looks like.
Yeah.
But typically, we'll come in and we'll get an effective back office in place first. We will get tax planning in place simultaneously, and then
Mhm.
we'll start to layer in some of the kind of finance strategy tools that you can
Mhm.
use to forecast and make some good decisions.
Wow.
And so that's how it typically looks. It's really a strategize and plan, build, maintain, and then there's various levels of that based off of your team, your organization, and kind of your needs at that point in time.
So yeah, I love that it's kind of a one-stop shop for the bookkeeping, the accounting, the tax prep. Because one of the problems that I've had before using sporadic companies over the years is, they would do like the IRS returns, but not like the local state return. And
Yeah.
then now I'm 3 years behind and didn't realize that, F&E taxes in the state of Tennessee weren't filed. And now I've got that aggravation to deal with.
Yeah, we're really trying to create that kind of one-stop shop, one throat to choke organization where
Mhm.
it's so fragmented and disaggregated. And to your point, like you as an operator, your highest and best use is not figuring out how to liaison all of these different things that you need to
Mhm.
run your organization. And so we're that partner firm that really comes in, professionalizes all this, and supports you in that journey.
Mhm. Yeah. So again, the kind of go back to the big beautiful bill and all of that. I know a lot of investors, they just feel like with every new administration, like taxes just like the rules just keep changing continuously, and it's so hard to keep up. Do we feel like these changes are going to be reliable? They're going to
It,
stay in place? Like how secure are
yeah,
we
this
with
is
this,
signed into
or do we know?
law. So
Yeah.
it's back.
So it's
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 back.
back. All right. All right. Yeah, because I think that's a fear as one party comes in, another one comes in, and then it just always changing. So can you guys help investors with, because you mentioned like estate planning, I think you said earlier, like for me, I have multiple LLCs. Like I know there's like the main LLC, and then it should kind of all feed down. Um, can you help us with that
Yeah,
type
so
of stuff?
entity organization is one big part
Entity organization.
of
Thank you.
our tax planning offer. So you get entity
Hmm.
organization. We show you kind of how you can optimize your entity structure as part of our
Hmm.
insights because that actually plays into the tax planning. Some of the strategies that we implement are actually just having your entity structured the right way. And then our ongoing tax
Yeah.
planning, we revisit that as frequently as we need to and at minimum once a year.
Oh wow, that's fantastic. So for people who are like, I'm behind, my stuff is a mess, it's in a shoebox, you're not going to make them
No,
feel bad. Yeah, I mean, make me feel bad or make them feel
absolutely
bad
not.
when they
No,
when they
it's
come to you.
it's let's get it right. So like it's funny at this
Yeah.
point, some people will come in and be really worried, and it's like it doesn't really fit because we've seen it and we know how to get it clean and get you up to speed and get you
Mhm.
compliant and make sure
Yeah.
that's just step one. And then it's really how do you actually unlock value
Mhm.
out of your back office, which is
Mhm.
is really what we like to do with our clients. But to that point, if you're 3 years behind, we got to get you cleaned up before we can really start adding a ton of value.
Right. Right. Okay, cool. And when you get that cleanup done, that's like you're looking at all of the things to make sure it's done just as well as possible. So we're not,
Yeah,
just slapping it together and paying a bunch of back
no, yeah,
taxes.
I mean, full blown kind of controllership. So we're producing timely and accurate financials every single month. And then our strategy and
Nice.
analysis team is coming in and really helping analyze those financials, help make better decisions.
Hmm.
And then our tax team is coming in
Yeah.
and helping you plan and helping you stay
Hmm.
compliant.
Yeah, I think it makes far more sense to have all of that under one roof instead of having an accountant and then a separate bookkeeper, and they always love to
Oh
fight
yeah.
with each other and tell each other
Yep.
who's smarter. I've had to get on a Zoom and tell everybody just
Yep.
relax. We're all trying to get to the same
Yeah.
place here. Um, so Jeff, one final question here for you. If an investor is just now hearing about the big beautiful bill, somehow they lived under a rock and they didn't know, what's the first thing that you would tell them to make this move to kind of lock in that upside or to capture some of those
Yeah, I mean,
benefits?
it's step one is really understanding what your current tax position is. Like, what are you planning on paying
Hmm.
in 2025? And if this is going to be a strategy you're going to implement, you really need to understand what your final tax liability is going to be in 2025. So you understand,
Hmm.
okay, well, how much real estate do I need to purchase to be able to effectively
Hmm.
offset that or at least reduce my effective tax rate? And so it's really understanding where you are today and what
Hmm.
your tax liability is expected to be for 2025 so you can plan. The way you do that is we got to have accurate numbers. We should have a good forecast, and that forecast should lead into our tax forecast, which is kind of
Hmm.
our whole thing. So, but I think that would be it. If you already know, wow, I'm going to have a huge tax bill. I'm already acquiring real estate. I'm already a real estate professional. Well, then
Hmm.
it's really just like starting to identify some properties that are still good deals, but that will be able to
Hmm.
generate some significant bonus depreciation for you to offset that. If I could
Nice.
add one more in, it's like if you qualify for being a real estate professional, which I'm assuming virtually everybody does in your community, make sure that box
Yeah.
is getting checked on your tax return because so many CPAs just mix checking that box, and you literally are not you're missing out on tax savings that you
Mhm.
should be getting. Like you might
Yeah.
even be taking depreciation, and if you don't have that box checked, it's not offsetting your active
Yeah.
income. So ask your CPA, am I qualified as a real estate professional and are you filing my taxes that way? Especially
Yeah.
if you own real estate.
Wow. Um, Guys, Jeff has given away like literally the keys to unlock real estate law and the changes that are built into this into the big beautiful bill. Permanent estate exemptions, immediate write-offs, bigger deductions, and more. So, if you are serious about scaling and preserving wealth, which we all should be, make sure you go. We've dropped it in the link here. Go to Acuity site and make sure you schedule a strategy session. Plan now before Uncle Sam comes calling and you're writing a really, really big check. So, if you guys got value, subscribe, drop a like, and share this episode with an investor who is still overpaying on their taxes. Jeff, thank you so much, man. I do appreciate you coming on. This is complicated stuff, and appreciate you coming on and giving it to us like we're third graders so that we can
Thanks so
understand.
much, David. I appreciate it.